Okay, so we are recording this webinar. So welcome to our Wednesday webinar. I'm Leslie Banas with the Community Foundation. So appreciate all of you. See some new faces on our Wednesday webinar. So if I can ask everybody to mute, you do have the ability to unmute yourself because we want to keep this interactive. You can unmute when you have questions, or you can write into the chat bubble as well. We do have a few announcements before we get into our presentation today on an update about the provisions in the CARES Act. So upcoming the Community Foundation, tomorrow we do have a webinar strictly for your board members. We invite staff to attend as well, but at 2 p.m. tomorrow, we're doing a webinar on, as a board member, what should you be doing to help your nonprofit in crisis? So please encourage your board members to attend. And right after this webinar, we'll have an email link that'll be sent to all of you that has the information on how to join tomorrow. We'll have a great panel of some Community Foundation board members and some community board members. We have the board chair from the YMCA joining us, as well as a few more. So you'll be sure to join. It'll be a fun and engaging webinar. We'll talk about that in a minute. We do have a board academy where we're talking about boards. We are going to do our first ever virtual board academy. So those of you that talked about wanting to get your board members who maybe don't live here or that have trouble coming in person, we do encourage you to get them to attend our board academy. So we'll send details about that, and that will be in mid-June. Our next book club, so this will be our last book club before Amazing Give, before we take a break till September, but we do have, our next book club will be coming up on June 18th. So we are reading 101 Mistakes Nonprofits Make and How You Can Avoid Them by Andrew Olson. And so that book is, please email us and we will get you a copy of that book for free. So you can read through that and join us in the discussions. We do have an exciting announcement that the author Andrew is going to be joining us for our discussion. So that will be really, he's very excited to meet all of us and from our community and talk through us about this book that he's written. It's a great book. I've started reading it. It's a quick read. It goes through the 101 steps, and you'll feel kind of guilty in some of them, but definitely something to learn from. And then finally, internships. So we are working with the Warrington College of Business at UF. They have what they are calling displaced internship students. So those students needed internships, and their internships this summer were either canceled or no longer there. And so they're trying to get them placed with internships with local nonprofits. So please reach out if you would like one of those. They have about 30 students they're looking to place. So far we have 6 nonprofits, local nonprofits that are working with them on securing an intern. So please reach out to us. We'll get you in touch with UF and help these displaced students find their internships. So that way it'll be a win-win for the student and a win-win for the local nonprofits to get that help this summer, especially, use them for the Amazing Give, use them for marketing, use them for, finance, anything that you really need in your organization. So there's a lot of information, but we'll put all of that in the chat while we're talking, and we'll be in touch. The last thing that will feed into what we're doing today is we did release a flash poll. We've been doing these nonprofits assessments that many of you have filled out, and the feedback we received was that the assessments were taking 30 minutes. They were taking a long time and very time consuming. So in order to reduce that, we're just gonna start doing flash polls once a week. So once a week, you'll get a poll on a specific topic. It will take you 1 to 3 minutes, sometimes 30 seconds to complete, and it'll be on specific topics. So the first one we did this week was on the PPP and the Paycheck Protection Program, and we have about 24 of you that have filled it out so far. Showing us that as of now, there's been about 2 million in the Paycheck Protection Program that's come into our community. And we have some more questions on that today. So it's going to lead right into the conversation and answer some of your questions on the reporting. So we'll go right into our speakers today. So we have with us Jeffrey Hogue and Samantha Hopkins with UBS. So I'm going to turn it over to them. We're going to keep it interactive today. So feel free to email to either to everyone or to me with your questions. And I'm going to turn it over to Jeffrey and Samantha.
Thanks, Leslie, and thanks, Barzella. It's good to see everybody today, or most everybody. Getting used to these video conferences as best you can. We used to, in Gainesville, being more face-to-face as we're everywhere else. So we miss seeing people, but this is, I guess, a close second. Samantha's having a little bit of technical issues, but she's on the phone with us, but you're not seeing her lovely face. But Sam is one of my partners. Together, we've worked with a lot of different types of clients, both individuals, businesses, and specifically foundations, endowments, not-for-profits. And that's one reason that I brought Samantha onto the call. She serves as an institutional consultant in addition to being an advisor, where she actually consults with not-for-profits, organizations, doing board education seminars, programs for those clients, as well as helping develop different tools that they can use, such as spending policy statements, investment policy statements, and helping to make sure that the investments and the allocations, as well as the selections that are being made, are being done so at the lowest cost and the best providers that can be done relative to the same kind of industry or same kind of clients worldwide or nationwide that she can screening it. So it does benchmarking for not-for-profits as well. So again, as a resource, we're happy to be a part of this presentation. I've been involved with the Community Foundation for many years, and it's really a great honor to have a chance to speak to you all today. Today, we're touching on a few different topics, initially all focused on what's happened with the CARES Act and the Paycheck Protection Program as it applies to not-for-profits. And so with that, I wanted to bring Sam and let her start off with talking about some of the just changes and updates as the IRS has given us more guidance on the rules. And with that, I'll let Sam take over.
Thank you, Jeff, and good afternoon, everyone. As they stated, we'd like to make this interactive, so feel free to jump in. And I know there's also been some documents circulated from UBS on the topics we're covering, so you'll have something to take away and refer to. But as Leslie mentioned, I know there's a number of organizations that already applied for and were able to receive some PPP funds. So at this point, some of the things that are important are just really making sure that you can qualify for a loan forgiveness at this point, because you don't want to have to repay those funds. So as you know, probably aware, but the funds, 75% of that advance that you got in the PPP would need to be paid for payroll-related expenses. So at least 75%. You can also use that funding to pay any mortgage interest, rent, or utility costs, but we need to make sure that you're keeping that spending at least 75% to payroll-related expenses, and that applies to employees making less than $100,000 a year. So when you're tracking that, just make sure that you're taking into consideration some of those rules surrounding that forgiveness of the PPP loan. For those who were not able to obtain a PPP loan, there are other relief programs that were part of the CARES Act. I don't know if there were any questions before I move on to any of the other topics, but if there's anything on PPP, feel free to cut me off there. I know those funds went pretty quickly and not everyone was able to take advantage of that.
So Sam, I know we have quite a few questions on this topic.
Okay.
We can camp out here for a few minutes. We do have some polls I wanted to launch. Please bear with us. It's our first time using polls. But I wanted to maybe launch one. One of the questions that we're getting, and I would like to see the answer, Sam, and then have your opinion about what you're seeing. But one question that we're getting a lot is if you need to set up a separate bank account for your PPP tax. So I'm launching the poll now just to see how organizations are handling this now. Like, did they set up a separate bank account to track the PPP funding?
Right.
So press submit.
I mean, that's a clean way to do it. It's not required under the provisions of the Act. So, but it is a cleaner way to track it. You do have to have enough expenses one way or another tracked to show that you utilized it for that fund. As long as those payments are being made for payroll and mortgage, rent, utility costs, it'll still qualify, but it's a little bit cleaner if you keep it separate.
So I'm going to leave the poll up. Thank you for a few more seconds, and I'm going to end it, and then we can share the results. Was everybody able to see the poll? Perfect. Let's see. So what we'll do is we'll share those results at the end because it's not looking like I got many of them secured. So maybe we can move on to our next question. Our next question, Sam, that we have is about PPP is how does it apply for those that are grant-funded positions? Many organizations, nonprofits have a grant-funded position. How does it affect those those employees that are grant-funded?
Right. So really under the PPP, it can qualify, but here's where your problem is going to come in, and whether you met the obligations under the grant itself. So yes, you can utilize it if you needed to, but the problem is going to be whether or not you can document to that ongoing grant that you satisfied the conditions of the funding. So I would caution you against doing that, because the funding should have been there. If the funding under your grant obligation can be utilized for other expenses and it's not directed towards an employee, then yes, I mean, use that funding to pay their ongoing payroll. But the question really becomes not really under the government program under PPP, it's really the obligations you have under the grant itself.
I would say too that the key question is the premise of the PPP is you don't want duplication of the funding. So under PPP, for eligible for forgiveness, you don't want to have there be a conflict that you would receive basically duplicate funding from two different sources.
Correct. Good point.
Thank you. Are there any other questions on PPP? And if it's too long to type, please feel free to type in the chat to unmute you, or you can unmute yourself and feel free to ask. I know this has been a hot topic, but I do have one more coming in. It says, can payments to the state of Florida for reemployment tax apply for PPP?
There may need to be a little bit of clarification. There is payroll tax, two payroll tax options. You can defer payment of payroll taxes, and there was a payroll tax credit. So those are kind of separate, and so I'm not real sure what the question's getting at.
I don't believe it applies to state taxes. I think it's federally related, but that's a great question to explore. I don't think we've seen any guidance as it relates to the state taxes. I think it's only from the federal standpoint for FICA taxes. I know it doesn't impact Medicare taxes, so it's only the FICA tax.
I'm sorry that I can't use the chat. I work for two different nonprofits, and in one of them, whenever we applied for the PPP, we did not have the grant-funded position covered by a grant, and now we do. And we did receive the loan. Can we use the alternate lookup period, because our grant-funded position is new? And can we do little raises with the PPP amounts so that we can utilize those funds?
When you're saying little raises, can you clarify what are you seeking new funding from grants, or I'm just not following the question? I apologize.
Okay, so when we applied for the PPP, we all were doing it under pressure. Everybody said, hurry up, do it, do it, do it. And so we were doing it quickly. And at the time that we applied, one of our employees was not covered under another grant. Since then, they are now covered under another grant. So another grant is covering their salary, but we received the PPP funds, and we can no longer use that position to use
that amount of funds, right?
Sam, I'm going to chime in. I think that goes back to, first of all, regarding the funding source, it was based on historical salaries to maintain those, keep people employed. So while the first person was not covered initially and was part of that, now that the financing is there, you essentially go back to having that dual resources available. And so that may become more of an issue of the forgivability of a portion of those loans if you now have that secondary source of income for it.
Right. So we can't use that income for that employee. But we're a small organization and we only have 2 other employees left to use it. So I've heard other people saying you can give raises using the PPP funds. Do you agree?
I have not heard that at all. That's the first time I've heard that even brought up. But I think the key question is, if there's a portion that you want forgiven, but now it's covered, hey, there's Sam, that you want to have covered, you have until, I think it's end of June. Is that right, Sam, for repayment without any penalty? Sam, you're muted.
I'm sorry about that.
So again, you have a limited time if you are to pay any of those funds that you did receive under PPP without any penalty, and you don't have to worry about the forgiveness. But I think the technicality of the raises is something that there just hasn't been any official guidance given on that at this point.
Yeah, correct. I haven't heard that question raised in any of the calls I've been doing so far. But as Jeff mentioned earlier, you don't want to have dual funded positions. So you do have an opportunity to repay. Otherwise, your loan may or may not be forgivable if you're not spending 75% on payroll.
But if you need interns, I know Leslie said they're trying to get interns placed.
Yes. We do have one more question. For the amount that's not forgiven, when will the repayment of loans commence?
Sam, you have that?
Actually, the repayment date, I don't actually have that memorized. I apologize. I don't see that listed in our.
We can try and get that answer back for you, Leslie. That's something we haven't.
Sure, we can.
Again, there's a lot of the stuff we haven't gotten guidance yet from the IRS. So.
Yeah, we're revising all of our documents as we get more clarification. But to avoid a penalty, I do know that you had to repay the loan by May 7th. So if you weren't going to be forgivable, you could return it by May 7th. As far as the loan payment schedule, I don't have a date on when that's going to start.
I know that September is a key issue here because a lot of these provisions were to cover through September.
Right.
So I think a lot of that plays in that, but I don't think there's been any direct guidance given on the repayment structure yet. I think it also depends on the loan itself, when you got the loan, what the terms were when they were granted.
We will follow up on that question though, and make sure Leslie has it to give out to you all once we can get some guidance.
Thank you. I think that sums up those PPP questions for now, but we can move on. If there's still questions, we can come back to them.
Okay. So some of the other topics, everyone talked about PPP because it was all over the news, but there are other options that you can seek to utilize as a nonprofit. One of them is the Small Business Economic Injury Disaster Relief or Disaster Loan, EIDL or EIDL. So that is another option that is out there. If you are a institution that did not get a PPP, you can, as a non-government agency with a 501c3 designation, D or E as well, you can seek additional funding through a loan called the EIDL loan. So I don't know if any of you are aware of that or if you have sought funding on that. Is that something you all have talked about as a foundation or not?
We have not touched on that, so I think that would be helpful to some more details.
Right. So basically you have to meet the same requirements you would have under the PPP loan, but it's really for entities that sustained a decrease in their ability to collect revenue as a nonprofit. So $2 million in funds were available.
That's the maximum size of the loan.
the maximum size of a loan, right? So that could be any amount up to $2 million. If you were impacted, you could apply for that loan as well. We do not have a lot of details as far as repayment of the loan on that either, but it's another source for you, as many nonprofits are seeing, their donations, and many nonprofits don't have a liquidity bucket that they were living on to begin with. So when the donations are drying up, they're finding it really hard to meet the obligations that they had as far as providing the services. So that may be another avenue for you to pursue, to find additional funding to help support operations as we go through this slowdown in activity, what you could say, with donations. So I don't know if there are any.
Well, I was going to say one comment on that is, so even if you apply for the loan and aren't granted it, there is an advance of up to $10,000 that's available to you. And even if you aren't approved for the EATL, again, economic injury, disaster relief loan, I guess it was called, disaster loan. If you apply, aren't approved, they still will give you an advance of $10,000 that does not have to be repaid.
That's what I was going to point. It doesn't have to be repaid. Even if your loan is denied, you can keep that $10,000 advance. So that's like an emergency funding for you if you're trying to obtain those. But
you cannot get both a PPP and an economic. It's either or.
Right. Okay.
Any questions on the EATLs?
I don't see any questions. I know that I see that we've listed the government site for that, for more details on that if someone has any questions.
Okay. So there are a couple more things, and we kind of referred to it briefly as far as other relief under the CARES Act. And one is the employee payroll tax credit. So the act itself provides for $5,000 in refundable tax credits per employee. So that allows you, as a nonprofit employer that was affected, to retain your employees without having to pay $5,000 in unemployment tax for them. So that's a credit against your share of the Social Security taxes on FICA wages as a result of the slowdown or shutdown. So the credit has to be reduced by any other credits received for qualified sick personnel or family medical leave under the Family First Coronavirus Response Act. So if you had anything already credited to you, that has to be applied first, and then you can deduct up to $5,000 of payroll tax as a credit.
Again, I don't believe that applies to states in any way. I think that's only federal.
Right. It's federal, FICA. So there's more details in one of the documents we sent out regarding qualifying wages. So it applies to 50% of qualifying wages up to $10,000 paid to each employee between March 13th and December. So it's for the remainder of this year. And it talks about how you qualify that credit. So, and this applies to organizations with less than 100 employees. Any questions on the payroll tax credit? Okay, in addition to that, there's also a payroll tax deferral. So the CARES Act provides that employers' Social Security tax, federal Social Security tax payments due between March 27th and the end of the year, December 31st, may be delayed. The deadline for paying the first part of that, half of the deferred taxes, is going to be December of 2021. So that gives you a full year plus, depending upon when you stop paying your payroll tax, to delay that payment. The remainder of the 50%, so your first is due December 31, 2021, and then the remainder 50% of the tax due is due 2022. So it gives you 2 years and change to pay that payroll tax into the federal government.
You'll still have to pay next year's tax when it's due, but
right. Well, yeah.
But this year's permanent 2 year delay.
This year's you can stretch out over 2 years. Now, this one is a little more flexible because you don't have to meet the same requirements as the payroll tax credit. So you can have more than 100 employers, and it doesn't have all the provisions about the Family First Coronavirus Response Act. So it's a little more flexible, but you still owe the tax. It's just giving you 2 years basically to pay that.
I think both of those provisions with payroll and taxes were really more designed to give not-for-profits and other organizations the ability to manage cash flows better.
Mm-hmm.
So if you're having a challenge because of donations being down or receipts or revenues from other sources, the government's trying to give us a way to at least keep more in the pocket to cover those expenses versus going and getting a loan if necessary.
Okay. Any other questions on the payroll taxes? Okay, and one last thing regarding the employee payments. The CARES Act is also affording you the ability to be reimbursed for 1/2 the cost of any unemployment benefits that were paid to your laid off employees. So if you did go through that and you're having to pay unemployment benefits, 1/2 of that can be reimbursed through another emergency unemployment relief fund through the federal government. So I don't know how many of you actually went through layoffs and have that situation happening, but the benefits that you're paying where the organization elected to reimburse the state for the unemployment benefits actually paid rather than having the state insurance tax pay for it can be reimbursed 50% of that through the federal government. Jeff, I think what we'll do now, if we don't have questions on payroll taxes and unemployment credit, we'll move into some of the other provisions that affect donors and affect cash flow, and some things that we might want to be thinking about as far as budgeting. So I'll turn it to you on those topics.
Thanks, Sam.
One question for
again,
Dawn.
questions, please.
On that last question for Sam, there was a question about, I haven't done any of this yet. Where do I even start? Where's the best place to get resources? Where should I go?
So I think the best thing that you should do at this point, since the PPP basically is already funded, you may want to look into the EDL and go through the government website. You put a link, correct, Leslie, out to that on your website. So I would start there. But basically what you're going to want to do is figure out where you stand as an organization and your budget and whether you can apply for any of this payroll tax deferrals or payroll tax credits. So I think taking a look at the rules that we've kind of highlighted for you in the documents we sent, as well as going on to the government link for an EDL or EIDL, is a starting point to see whether or not that's something you want to undertake. So if you feel that you could potentially repay any loan that you got and you need emergency funding, then that is a great way to start. Otherwise, you're really going to want to start looking at how do I defer any payroll taxes or get any credits eligible to my organization. Because so far what we've talked about, that's really the only thing you have optional left unless we come out with any more payroll programs that are going to be funded. But right now, as far as we know, we're finished with the PPP.
For this round.
For this round, who knows what'll happen, but yeah, and there's a lot of tracking and a lot of nuances that go on with this. And the guidance, it was passed in a very, very short period of time. So understand as we're working through this and we're getting more clarification, these things are not cut and dry. And so you want to just make sure you keep good records of employees and where the funding's going. And somebody asked that question, should we separate out our funding? Yes, it makes it more clear, but if you can show the actual expenses, then you're going to be fine under that PPP program. But you also want to try to think about whether it makes sense. It may not make sense for your organization to obtain a needle, because if you obtain it and your donors have dried up and you don't have funding come back, you're still obligated. That's a loan. That is not a forgivable loan. So, those kinds of things are something that you really need to look at as an organization, and you know your donor base better than anyone, and whether or not you really want to apply for a loan. It may make more sense to try to defer payroll taxes and or apply for any credits that you can get under the programs.
I would also add, it just happened to be in today's Wall Street Journal on page A12, if y'all look for it. there's an article called "The Virus Attacks Philanthropy," and it talks about some of the challenges that not-for-profits are facing with everything that we're all facing, not only personally, but as organizations. And a couple of interesting things I took from it were, and segue into the donor side of things, obviously, most not-for-profits operate with pretty small budgets. They basically use their resources as they come in to go right out. A lot of challenges, a lot of folks have found themselves in a cash-strapped position. If they had maintained large balances, then of course, there's fears out there that the donors may or may not feel like the organization needs the funds because they've got funds. The other challenge is too, they may have a lot of funds, but they're restricted funds. And there's a lot of larger organizations out there who have been reaching out to some of those restricted donors and asking them to remove some of the restrictions to free up funding for other sources. So I invite you all to check out that article from this morning. It was pretty good. It was very short. It was more of a commentary, but it does touch upon the many challenges, not only that we're seeing as a society, but this kind of came at a perfect storm with regard to some of the changes that happened with the tax laws as it affects donors. So with that, I'll segue into that. Many of you all are, I'm sure, familiar with the qualified charitable distribution that came into play, where folks receiving IRA required minimum distributions when they reached that mandatory age used to be 70 and a half. They could, beginning in 2006, they could make a donation directly to the charitable organization and not pay income tax on it. And Uncle Sam wouldn't get taxed either. It was a win-win for everybody. That's been renewed basically every year, every 2 years, save for one, until 2018 when it was made, we'll call it permanent. Nothing in Congress is permanent. And that works very well. So as an advisor, Sam and I both, when we're meeting with our individual clients, our first thing to tell folks, if they have resources, let's say they have the same money in a taxable and a retirement account, don't donate cash. If you're going to donate a highly appreciated stock, that's fine, but donate the IRA. It's the best tax move out there. So we've been telling our clients that for years. Well, in 2019, at the end of the year, there was a tax code change that basically moved everybody's required distribution from 70 and a half to 72. So without knowing coronavirus is coming, we just entered a 2-year period where there's a good number of population who are not going to be taking their distributions for 2 years. They aren't required to. So right there, we were going to see I've already seen a slowdown in charitable donations. Then coronavirus happens, and we have the the CARES Act that comes in play. And now, effective in February, all required distributions from any retirement account whatsoever have been suspended for the rest of the year. So no one, even if they're 90 years old, no one is required to take a distribution from their IRA. They still can. They can still do a qualified charitable distribution up to $100,000 as long as they're over the age now 72 or already doing RMDs. They can still do that, but it's not likely that folks are going to do that. And the reason that was passed as part of the CARES Act is that folks didn't want to make people sell out of their IRAs at a lower value, and they want to give it a chance to recover. So it's good intention, but it obviously has impacted people's plans on giving. So something to keep in mind is that not only are we looking at a year or two for certain donors who are maybe getting ready to start taking distributions, but now they don't have to for 2 years. You've lost those folks, and then now you aren't getting any charitable distributions out of an IRA unless someone feels that that's appropriate. And since it's a non-taxable event to everybody, it doesn't really impact the tax side of things. So that has been a big change. Another thing has been the Secure Act did change what's called the stretch provision. The stretch provision basically said that if you're a non-spouse inheriting a retirement account from someone, you have 10 years now to take those funds completely out of the retirement account as an inheritance. It used to be you could stretch it over your lifetime. Now, if you're a minor under certain ages, you can, but any second generation essentially inheriting retirement accounts will now have to take that money out in 10 years. So that hopefully will replace some of that, because if the point of the age of taking required distributions, you can start making those distributions to a charity. So hopefully that'll speed things up, kind of counterweigh that. But again, this year, everything's been eliminated from charitable required distributions from retirement account.
So
Any
Jeff,
questions?
talk about also, you know, we talked about the fact we've lost those donors from 70 to 72, but we have a new provision under the CARES Act where your higher income individuals used to be limited on their charitable deductions, and that's
Right.
changed. So that may be
Right.
an opportunity.
So in 2018, and when the tax laws changed, we went to this new higher standard deduction, which basically took most of America out of the itemized deduction for charitable donations. You basically had to give quite a bit. And of course, cash gives you a different benefit than an appreciated security. Well, with the standard deduction being raised, a lot of folks saw they weren't getting a tax benefit for making a donation anyway. This is excluding charitable distributions from an IRA because those didn't even apply. But just making small everyday donations, they weren't getting to write those off at all anymore. So we saw an impact to that in giving, and I'm sure a lot of the not-for-profits have as well. Well, this year with the CARES Act, what Congress did was they basically said that, first of all, everybody can get a $300 above the line deduction off their taxes. So if you made $100,000 and you donate $300, you're eliminating $300 right off that from your taxable income. Doesn't have to do with itemization. It's just straight off the top. $600 for a couple. So again, that's a freebie. And that, again, if you are still making gifts and you itemize, that's on top of that. It's a straight line deduction. But additionally, what Congress passed as part of this is the ability for folks to zero out their adjusted gross income. So in other words, it used to be you could only claim up to a certain percentage of your donation every year, and you carry the rest of it forward for 5 years. This year, with the rules being amended for this year only, if someone wants to make enough charitable donations to basically offset every bit of taxable income they have, they can do so and basically have zero taxes at the end of the year by managing their tax donations. So it still is incenting people to give, but a lot of people aren't familiar with that rule yet. And of course, when they don't talk to their CPAs till the end of the year, they may not know about it until it's too late. So we're trying to communicate that to our clients. And a lot of this comes back to giving people opportunities for planning. If you consider maybe how could you maybe maximize all of this for someone's personal wealth? If you want to basically do a Roth conversion, which is a taxable event for folks, but if you make an offsetting donation to equal that out, you could essentially do a Roth conversion and essentially pay no tax by making a qualifying charitable contribution. So there's a lot of wealth planning and a lot of estate planning that goes into play that can help with tax planning, but also help make sure that people's long-term gifts and goals are being met despite some of these changes that we've seen in the tax code, just because the CARES Act has given us some provisions. Of course, with the market being down, with the economy being slow, a lot of folks have been skittish about giving and letting go of their monies anyway. So I think this passage of these acts have been trying to help people get used to what they were doing before, keep doing it, and give them a little bit more of incentive to keep that flow happening.
We have a couple questions. One is someone's asking, how long is the new provision for the RMD set to last? Is it just 1 year? Or?
Yeah,
just through the end of the year.
Just this year.
Mm-hmm.
And do you see any notes that could go further into next year?
I would be very doubtful of it,
Right.
since the past tax law basically accelerated that with the elimination of the stretch provision, and they moved everybody out to 72. I can't see them really doing that unless we continue to have a major crisis, economic struggle, and but I've not heard any talk about that whatsoever. I was very surprised that was even thrown in there.
So the next question, and it's a little lengthy, but I'll try to summarize it. I think basically what the person's asking is, all of this stuff is quite confusing. How can we share it with our average donor who might be affected by this?
Great question. First of all, the documents that Leslie's going to be sending out, I didn't know you hadn't sent it out yet. There's actually a document in here. It's called Wealth Planning Alert, and it specifically talks about charitable giving under the CARES Act. You can share that with your donors. We're constantly coming out with more updated pieces, as is everybody on the street. But it's a good, one pager that just talks about some of the basic provisions. I would welcome the opportunity to have one-on-one conversations with any organization, as with Sam, to how to approach this, either through developing a mailer or developing something that you can communicate out. We can give you some resources, and we can of course do a conference like this as well with your donor base and help you out. There's a lot of information out there. The bottom line is, when you start getting down to the donors, it comes down to individuals' needs and preferences based on their situation. So I think it's just making people aware that, you know, a lot of people still don't even know that they can do the charitable distribution right from their IRAs. So especially those people who weren't yet taking distributions, first conversation I have when they're 69 or 70, now it's 71 or 72, is first thing you need to know is this is an option you have to control your taxes. So I would also reach out to any professionals on your board, or, you know, with your CPAs, because they're the ones having conversations with these clients as well.
Does anybody have any questions they want to unmute or continue to type in the chat? Well, thank you guys for being with us.
Well,
Any final
There's
I was going to say one other thing,
yeah.
Leslie. Sam, one thing that really wasn't talked about much in any of the literature we saw, but is important, I would bet that most of these organizations on this call and out there have some sort of retirement plan for their employees.
Right.
And there are specific provisions under the CARE Act regarding retirement plans. So I thought Sam would touch on that briefly, because she also serves as a consultant on that.
I do retirement plans for many organizations. So just to highlight the two main provisions, there's some nuances around it if anyone has questions, but there is a new distribution option. Both of these things I'm going to talk about, they're optional. So even though the CARES Act allows for it, your plan has to actually make the adoption. So you have to, as a committee, decide whether or not you want to take advantage of this. So one of them is what's called a coronavirus-related distribution, CRD for short. And basically, it's like the old hardship distribution, and people keep referring to it as a hardship, but it's a separate option that you have to adopt, and it allows a participant to have access to funds if they had a financial distress or hardship related to the virus. As an employer, you're not obligated to find out whether they really did have a financial hardship, because you may be thinking, oh, I didn't lay them off, they shouldn't have had a hardship. But it's really their family entity, it's dependents and their spouse, and any financial impact they may have had. So they can take a distribution and they get to alleviate the 10% excise tax by taking that distribution through the CRD program versus a hardship distribution. So there's also tied to that the ability for them to pay it back if you allow for that within 60 days. So they don't have any federal income tax on it. So that's one provision surrounding a distribution. The other main area is surrounding any loan programs you have in your retirement plan. So maximum loans on a retirement plan used to be at $50,000. If you opt for this, we can allow a participant to go up to $100,000 as a loan against their retirement plan. So one is increasing the loan size amount, and the other option here is whether you want to allow for loan payment deferrals for 12 months. So that's 12 months from the day they apply for it in 2020. So if they apply for it in September, they have till September of 2021 before they have to make a loan payment. The caveat there is they are going to accrue interest on their loan, so their loan balance is growing while they're not making those payments, but it is another provision that you can allow for within your plan. So those are probably the biggest provisions that apply to retirement plans, but I just want to make sure it's clear, if you have that out there as a plan committee, as an investment committee, you have to actually make that decision to adopt those provisions. So it may be coming up because it's been on the news. You can take $100,000 out of your retirement account. You can do this. So if it's coming up, know that as a plan committee, there are steps you need to be going through to make a decision whether or not we want to enact those optional provisions under the CARES Act. I can go into more detail on that, but I don't know how many people this applies to. So yeah. I just want to make sure we cover retirement plans.
It's important to know. I would say, please, Marzella and Leslie know to reach out to us. But if any of you all have any questions specific to your organization or just in generalities, please feel free to reach out to us directly. One thing that I think is critical of this, both from an individual standpoint, the families and businesses I deal with, and Sam is seeing with the not-for-profits, is it is incredibly important now to realize how great it is to plan ahead, how important it is to have a spending budget. We hate that word budget, but having a spending policy or spending budget for an organization. as well as, evaluating, these are these black swan events that we never expect to happen, but life does happen. And a lot of the folks we're talking to, it's all about how do you plan for these uncertainties and managing the risks that come with this. So if it's cash flow basis, if it's financing, if it's any of those sources, not just investments, that's what Sam and I do as consultants and working out with our clients to help them look at all the wealth scenarios. And if we're not the right solution, I've been in Gainesville since 1974. I know enough people. I can help guide people to the right place, as Ken, Barzella, and Leslie. But to have an expert like Sam, who works with not-for-profits and foundations and retirement plans all over the country, it's a great avenue.
Right. And I think it's also important to note, we have collateral that can help you through these programs and understand these are changing, and we're getting more clarification on them because they were pushed through so fast. But know that what we do as an organization, and specifically what I do, is really working with those nonprofits to help you design and craft an investment policy statement, but more importantly, a spending policy statement. And that gets down to defining those buckets of investments, including a liquidity bucket. So Jeff's referring to that, but this is what I do with these organizations to try to help them with their budgeting process. And how do we put kind of guardrails around and give our organization a financial backing and setup that's going to allow us to get through this type of unprecedented event just through this planning process. And that's really, we do more than investments. We're working through both the investment policy statement and more importantly, I believe, the spending policy statement. Any other questions, Leslie, that we have right now?
I don't see any more questions coming in, but I'll be sure to make sure we get those documents out with your information if people do have questions they want to follow back up with. And we'll be in touch with the Community Foundation with any of those updates that we talked about today or any additional documents that we can share.
Great.
Okay.
And I'll continue to forward things to you all if I come across something.
If we get updates, right.
Well, we appreciate both of you being with us and sharing your expertise on this. I know it's complicated and changing every day, and we appreciate you being with us today. So thank you.
Thank you, Leslie. Thanks, Barzella. Thanks, everyone.
And hopefully we'll see all of you tomorrow. 2 p.m. is our board webinar. We'll send an email about that soon. And finally, the flash poll. Please, I stuck the flash poll in the chat for those of you that want to grab it real quick if you haven't filled out that flash poll yet. But thanks everyone so much, and we hope to see you back in 2 weeks on June 10th. We are having a webinar about how to use social media to create your movement for your organization. And that'll be done by Chris Strub, who will also be, he is called the Giving Day guy, but he does a lot around social media across the country. So he'll be joining us, and he's also the gentleman that will be joining us for the Amazing Give in August. So hopefully you guys will get a quick introduction to Chris, and he'll be doing a presentation about how to use your social media to create a movement within your organization. So look forward to that, and we'll see you all soon. Thanks, everyone.
God bless.